But we also have our feature speakers today who are going to talk about raising capital and roadblocks that you need to watch out for. And just checking, and will the presentation be available afterwards?
Yes.
Yeah, okay, so they have some wonderful slides, 16 slides, and so when Annette sends out the roster, she'll also send out a link so that you can get the presentation. Our speakers are Neil Gordon, who is a finance executive, CFO, and was CFO for a company, Echo Inc., that was a New York Stock Exchange company, had $300 million in revenue, and so, you know, very experienced in the finance area. And we have Ed LeFevre from Foley and Lardner, a partner at Foley Lardner. He works in mergers and acquisitions, in private equity and venture finance, a partner in the department. And so they're going to talk about, you know, important securities law issues that you need to think about when you're trying to raise money, and including examples of companies in different stages and issues that you need to face. And so Neil and Ed, why don't you come up and you'll lead us the way. Tell us about roadblocks that we've got to avoid. It's for you, Neil.
Thank you, Rob. Okay, this works. This works. Okay. Sure, we'll see if we can get to the next slide. Hey, it works. Okay, so as we were putting this presentation together, and I'm at home working on the slides, and Laura, my partner, says, all right, so what are you doing? And I told her, and she said, look through the slides, said, well, you have to start with a story, because you can't just go do a presentation. So I said, all right, so we'll start with a story, and this is a true story. I want to mention, let's keep this interactive so that we don't have to stand up here and talk for as long as we have to talk. Comments, questions as we go, don't hesitate to interrupt. So this is a true story with a little bit of name change, and like any other story, it starts once upon a time. So Rita, who's a real person, Rita lives in Dorchester. Her son-in-law says, hey mom, I'm starting this company, I'm in New York, and I need some money for my startup. And Rita says, sure, okay, great, what do you need? $30,000, and in it goes, Rita thinks she's buying 10% of, this is son-in-law Corp, because they changed the name. 6 months later, her son-in-law is about to do an angel round. He's talking to angels and says, oh wow, I forgot to issue any stock to me, right? And so if you look at the stock book, Rita owns 100% of the company. And he says, well, I'm the founder, I'm the CEO, so I need to issue myself the other 90 shares. Anybody see a problem with that yet? Great. So he goes to his lawyer and his accountant and says, I need to issue myself these 90 shares. And I'm doing an A round, and here's my valuation. And they say to him, okay, great, that's compensation to you. And so you'll owe the IRS $350,000. Is that a problem? Yeah, that's a problem. So what they did, they lost all of the paperwork relating to Rita shares. They shredded that. They replaced it with a convertible note. They completed an angel round also for convertible notes. So all is fine so far. 18 months later, the company's negotiating with a venture fund, and as is not unusual, the company says, we have convertible notes, and they get this much stock on conversion as soon as you put in your $3 million. And the venture investors say, well, no, not exactly, that's a little bit too rich, so we're going to have to renegotiate them down. And everybody agrees that's okay, the company agrees that's okay, the angel investors and Rita agree that's okay. Everybody is going to convert, and they're going to get this new issue of preferred stock, except Rita's not an accredited investor.
And just to add a little bit here, an accredited investor from an SEC perspective is essentially a set of standards that provide that you are allowed essentially to invest in private securities. And the general rule of thumb is that if you make more than $200,000 a year individually, or $300,000 a year with your spouse, or have net worth in excess of $1 million, not including the value of your home, congratulations, you are licensed to invest in risky securities. But it's an issue that comes up whenever companies are trying to raise money, and it's a common term that gets used quite often.
And Rita wasn't accredited when she invested her $30,000. She wasn't accredited when she took the note instead, and she's not accredited on the eve of trying to raise $3 million in venture capital.
So as the lawyer, we try not to get in the way of companies raising money. It's hard enough. And so, our presentation is entitled, roadblocks. I like to think maybe there's no roadblocks, just speed bumps, and some of them are bigger than others. It's, from my perspective, just like in this example, where the founders realized that maybe they should have structured or timed things a little bit differently. There are always ways to address the problem. Some ways are more painful than others. But in this case, you can see that there's no bad intention. Nobody's trying to defraud anybody. You have a family member who wants to support the business, but all of a sudden these security laws become important, and the reason why is you've got this third-party investor coming to the table. And this third-party investor is really going to be concerned about two things. One is the money coming in going to stay with the company you're investing in? And one of the consequences of not complying with securities laws is that the people who bought the securities in an offering that was not compliant with securities laws may have a right of rescission, may have a right to come back and say, wait a minute, you didn't do what you were supposed to do. Frankly, at the time, they're probably thinking, I don't want to be in this investment anymore, whether it's related to the company or not, I want my money back. The next investor is not going to like that. The second is that when it comes time to sell your company or to go public, and that's why, from my background, I approach all offerings from a perspective of how is it going to impact potential future financings or liquidity events. There's a legal opinion often that's involved from a law firm that basically says to a buyer or an investor that everything's been done properly with respect to compliance with securities laws. So when you bring in a law firm to help put together more sophisticated investment transactions, these issues tend to become more important because the law firm is thinking in advance, am I going to be able to do what I'm going to need to do on behalf of my client?
Okay, so we'll get back to Rita in a bit. Show me the money. Where's the money? And I've laid out the pools. We've got family and friends. That's a little circle. Venture funds, individual angels and angel groups. The public markets, public funds, crowdfunding, people you don't know and perhaps can't get easy access to. That's the large group. But if we compare that to who you know the people that have the least amount of money, and you don't know the people who have most of the money, right? And all you need to do is get in contact, right? But if you don't have their phone number, getting in contact puts you right in SEC land, because there are things you can do, things you can't do. I'm sure Ed will have some comments. So how do you get from people you know who don't have a lot of money to the people that you don't know who have all of the money that you need to launch your venture? I'll read it and I'll leave the next one to you. Right? It's very simple, and the SEC says, hey, write this. They wrote it. A company may not offer or sell securities unless the transaction has been registered with the SEC. That would be like going public. And then here's the key, or an exemption applies. Or an exemption applies. So if you don't actually want to do an IPO to launch your startup, and you're raising capital, you need to fall into the or an exemption applies category. Okay, what does that mean?
Okay, all right. And these laws go back quite some time. This all goes back to the 1933 Securities Act, and they're intended to protect investors. And that's why the laws tend to be quite broad. And a security, by definition, is more than just a piece of paper, a green stock certificate that says I'm selling common stock. It could be stock, it could be bonds, it could be convertible notes. Basically, almost anything you can think of where you are issuing something in exchange for money, and it's supposed to have some type of accretion in value over time, is a security from the government's point of view. Again, because they're looking to protect investors and to have issuers think through these different compliance issues before going forward and raising money from people.
Okay, or an exemption applies. Have fun with that.
Okay. All right. So I'm going to go hopefully far out. I'm happy to go as deep into these exemptions as you would like now or later. I'm thinking you probably didn't come this morning to get a certificate in blue sky compliance. So I'm going to do this in two ways. One is I'm going to quickly go through the various exemptions that are available, but then I'm going to come back and approach it from what I think is the issuer's perspective. So the very first thing is that these are exemptions from the general rule that, again, you can't issue securities unless they're registered with the SEC or an exemption applies. You can't do basically a public offering without going through the SEC registration process. Now, there is in the base rule a position that issuers can and sometimes do take, which is that just without even looking at these rules, I know I'm not doing a public offering. That's called a 4-2 offering, and that's something that often is the backstop to solve a lot of these issues. Not recommended, but it's there. The way you can make sure that you're in compliance with the SEC rules is to fall within one of these exemptions under what's called Reg D. And these are specific rules that tie back to the 33 Act that are meant to, on a tiered basis, increase the amount of compliance required on basically two factors. One, how much money are you raising? The idea is that the more money that you're raising, the more likelihood is that the people are less known to you, and that there might be more of an effort to, through intermediaries, tell a bigger story to raise bigger dollars, right? So the more money that's raised, the higher the scrutiny. And then also, the how well do you know these people, and how capable are they of making a sophisticated investment and losing their money? So the other side of it is that in addition to how much money you're raising, who you're raising it from. Are these people in the business of making investments, and are they in the business of basically investing and assessing investments maybe for themselves or for others? So with that, Rule 504 is the smallest rule in terms of dollar threshold. You can raise up to $1 million, but there are requirements that if you want to do more general solicitations, you need to actually register that offering with a state securities office. And every state has its own set of blue sky securities laws. And the registration process per state is as complicated sometimes as the federal registration. So it's not something that you really want to do. If 504 can be available for very small offerings that don't involve any kind of general solicitation. 505 is in the middle. It's up to $5 million to accredited investors. Again, those are the folks that make 200 individually, 300 with their spouse, or worth more than $1 million, not including their home. And up to 35 non-accredited investors. And there are certain disclosure requirements in the way that you conduct that offering. Rule 506 is the one that's most common in my world, particularly where you are issuing securities to institutional investors, where essentially you can issue an unlimited, you're not subject to the $5 million cap, which a lot of Series A and Series B rounds obviously would cross that. And you can still issue up to 35 securities, up to 35 non-accredited investors, going back to our example. But those non-accredited investors need to be sophisticated, and they need to basically meet certain softer standards in terms of their ability to assess the investment opportunity itself. The last bullet point is the Jobs Act, which was recently enacted. It could be the subject of a whole nother morning. Essentially, it's another piece of Rule 506 and it provides for investments pursuant to SEC registered portals, for crowdfunding. There are certain limitations by investor based on how much you make in terms of how much you can invest in this type of crowdfunding opportunity. And it's essentially, the jury's still out in terms of how well it's going to work and how it's going to work in terms of the trajectory of a startup company that will eventually be looking to raise venture capital. But it is another exemption that's available, particularly for companies that are looking for alternatives to 504, 505, and 506, which are designed for more traditional fundraisers.
All right, and to end the Rita story, the transaction that ultimately was done for venture financing and the conversion of notes into preferred stock was a Rule 506 offering. Rita is not an accredited investor. She was one of the allowed 35 non-accredited investors. She is not a sophisticated investor. If she was a sophisticated investor, she would not have given her son-in-law $30,000. But so there's an out now, and so you can either be sophisticated and understand the transaction, or with a purchaser representative, someone who can help advise you and be with you and help you with that investor. And that's what Rita had, a purchaser representative, and so that transaction closed, and closed legitimately, and Rita does not have a right of rescission.
Right, and so just to come back, as I said, from the overlay, having gone through those technicalities that probably without coffee put everybody even more to sleep, if you're an issuer and you are thinking about raising money, these issues are important, and your lawyer will walk you through them. But if I had to walk back and say, okay, my pre-rules of thumb would be, if you can, raise money only from accredited investors. Of course, you're not going to turn money away from your immediate family, but by and large, if you start raising money from somebody who's not accredited, you need to step back and say, what's a potential issue here now and in the future? Second is, no general solicitations. Be very careful in the way you go out saying, I'm looking to raise money. If you put something on the internet, on your webpage, if you distribute something generally that says, here's an opportunity to invest in my company, that also could create issues for you down the road, because it will blow a lot of the exemptions that are available under securities laws. That's a no-no. And the third is that oftentimes people will come to try to help you raise money and look to take a percentage of the dollars raised. They say, well, if I bring somebody to the table and they invest in your company, I'd like to share in the potential upside. That is an issue unless you're a registered broker-dealer. Because again, the SEC takes the view that people who get compensated to raise money for others have a personal interest, may or may not be as sensitive to making sure disclosures are made fully and fairly, and therefore they need to be on the radar screen of the government authorities, and they, in many cases, need to have certain capital requirements in case there's any issues.
So that would be the third time you said, check with your lawyer. Right?
Shameless plug, but yes.
Okay, so you really do have to think this forward as you're raising capital. And in your basic planning for capitalization, how much do you need? How much do you need now? And how much might you need later? Who do you know? Who has the money? Who can write you a check and actually get you funded? And then with counsel, which rule or exemption applies, because that will tell you how you go to market to raise capital. And then lastly, will you live happily ever after in your story? And getting it right as you issue in seed round, angel round, whatever you want to call it. Each round you do affects the next round and can affect your happiness going forward. So how much do you need? And I describe that as said, how much do you need or want in this round? And they may not be the same thing. How much are you going to need or want in a next round? And how much are you going to need or want in subsequent rounds? And that you should know before you take your first dollar from an investor. Because the first dollar you take will impact the ability to raise a subsequent round depending upon who that investor is, whether that investor is accredited, whether that investor is going to be compliant with future requests, because the next investor is not going to like whatever the first investor got. And there's sort of constant negotiation and renegotiation with all of the friends you've acquired along the way.
And from my perspective, from a disclosure requirement, here you are, you're trying to raise money, you're going to have a bunch of disclosures and risk factors telling people that this is speculative investment, they may or may not make money on their investment. And at the same time, you're, as Neil says, you're trying to think forward in terms of your need for capital. And also, as you're doing your business plan and you're being coached up, you know, if you're going out to a VC, you're trying to have a 5-year plan that gets to certain metrics, certain dollar amounts that show that the investment would be compelling in the long term to an institutional investor. And that's the way it all trickles back, right? Because initial investors don't want to get into a company that's going to run out of money. So they're going to say, okay, is this company going to be financeable after I get the company to the next level? And is the amount of company that I'm getting, taking into account the need for future financing and the dilution, going to be sufficient to get past these risks? And am I getting the appropriate premium for the risk that I'm taking at the early stages? So you're going to this initial investor and you're saying, okay, here's my story. Well, most companies have difficulty forecasting, you know, with any level of certainty where they're going to be in 6 months, let alone 5 years. Having said that, you also know that you need to fit within a certain scope of the world in order to get the right people interested in your company. So there's a tension there. So the balance would be, you definitely need to have, you know, don't let the focus on securities laws get in the way of telling your story and making reasonable assumptions as to your projections. But having said that, you have to come back and say, these projections are based on these assumptions. Make sure that those are clear so that your investors know that, okay, if everything goes well, and who knows if things will go well, this happens, and on that basis I'm making my investment. But I have been told, and I have thought about the idea that if the company is unable to get to beta, if a certain number of customers don't sign up, if I don't get through the regulatory, if the company gets through the regulatory process or not, all those issues are key to my investment decision.
Ed used the word dilution. Could you talk about it? Because there's a lot of misconceptions. Okay, when you keep raising money, your percentage goes down, and that's not dilution. Okay, if your valuation is going up, I had this education the first time I worked with a VC. Just because your percentage goes down, a lot of founders think they're going to keep the same percentage, but if your total valuation, because the shares are going up, everything's going up, that's not dilution. Please explain that.
That's absolutely right, John. Thank you. So I don't know if everybody could hear that, but basically, oftentimes, especially for the first-time entrepreneur, there's a focus on keeping percentage in the pocket, right? Thinking that I want to keep as much of the company as possible, and that actually makes it more difficult to negotiate with an investor. Plus, to tell you the truth, in the very early stages, there aren't really comparables you can look to in terms of saying, okay, I'm going to do a discounted cash flow analysis and this is the valuation of the company. It's good old-fashioned negotiation, and there are certain ranges that typical friends and family rounds and Series A rounds will fall into. But to John's point, it would be better to have 10% of a company that's worth $100 million than hold on to 90% of a company that's worth $1 million. And so that's why you can't let the percentage itself become the key driver for the negotiations. You always have to look at in terms of percentage and value of what you have a percentage in. So that's to John's point, and it's a good one. When we say taking into account future dilution, dilution's not a bad thing. Dilution means that hopefully you've raised money at a higher valuation and you have something that's worth more. But to my ultimate point is that when you're thinking through, okay, I'm going to be diluted, and that's not a bad thing. But if I go from 20% down to 5% by the time the company goes public or is sold, and I say at the time it goes public or is sold, the company is worth $100 million, $200 million, whatever it is, what would be my projected return in a best case scenario? Then you step back and say, okay, what would my return on investment be based on the dollars that I'm being asked to invest? So dilution is basically part of the calculation to assess your potential return on investment, but dilution in itself is not a bad word.
Yeah, I tend to advise that this comes up often, and I hear, I don't want to lose control. And so dilution sort of affects, to me, three areas. One, what percentage of the economic value do you own? And it's hard to argue that someone is investing in your company and you should still retain most of the economic value. That's fairly straightforward in terms of how you divide up the pie. A lot of entrepreneurs that I've dealt with said, I don't want to give up control because I don't want them to fire me. I don't want them to change the direction of the company. Well, you can own 1% of the economic value of your particular enterprise and have investors own the balance, and you can have 100% of the votes, if they'll let you, which they won't. But depending upon who your investors are, you can certainly get super voting, and you can certainly, and easier with friendly parties as investors, have control over the votes, even though you don't have control, a majority of the economics. And the third hat is not only of sort of founder and owner, but the third hat is as employee. And if your concern is, I need to have control because I don't want them to fire me, you don't need voting control and economic control in order to have employment control, because that's a whole separate issue, a whole separate contract, and there are lots of us, I suspect, in this room. I work for a New York Stock Exchange company. I was an employee. I had some protection against termination. I didn't own any roundable whole percentage of stock, and I certainly didn't control the public company that I worked for. And so you can control yourself through, control your future, to some extent through voting, to some extent through contract, without saying, I can't ever sell more than 50% of the economics for all of these other reasons. Separate them and deal with them one at a time. You won't offend your investor by saying, by the way, I'm concerned that you find that your son-in-law or somebody needs a job and I'm out and he'll be in, and I want to be protected against that. It's not an unreasonable thing to say, and they won't walk. They may not give it to you, but they won't walk because you've asked. So we've put through a couple of examples. We're going to need your help. How do we fund these particular enterprises? The first one, High School Rock LLC. This was an actual conversation that took place among some of my high school friends on Facebook. It's not a real company. They're not actually going to do this. But let's pretend that we're actually forming this company to do a one-time only garage band high school reunion concert. Here we go. And if you read the footnote, yes, I did go to high school with Steve Tyler. He was Steve Tallarico. Then, I'll tell you, my brother is 3 years younger than I am. He also went to high school with Steve Tallarico. Okay, here we go. So we formed this company. We're going to do a band. We're going to do a concert, and the budget says we need $500,000 to hire a place and do the marketing and get insurance and do all those other things. How do we fund it? What do we do? Where would we go, and what are the considerations?
Alumni.
Pre-sale tickets.
Sell tickets.
Pre-sale.
Pre-sale. Securities issues with pre-selling tickets?
Not if it's just a ticket. Just an admission is basically a license to go and see the show. It's not a share in the upside of the event. No, that'd be fine.
Okay, how about if I'm not going to put the ticket money in escrow now. I'm going to take the ticket money and I'm going to do some more marketing and spend it and put a deposit down on, the garden.
But that's an issue, right? Because at that point, then you're basically asking somebody to put money in your hands to fund a venture that may or may not be, secure. So when you get to along that line of the spectrum, yes, looks and smells more like a security.
Even though it's a ticket.
Even though it's a ticket.
That's a good idea.
You outsource, you get a promoter. He puts up all the money for a percentage of the revenue. ticket sales.
A one-time investor,
One
promoter
time,
person.
They put up all the money and you give them cut them a deal for a percentage of ticket sales.
Okay, so that sounds like a security to me.
That one, it sounds like a security, but you have a promoter that's coming in, basically underwriting the show, taking a percentage of the upside you have. You have one entity. You're not going to a bunch of people asking to raise money. This is somebody who's in the business of putting on shows. That's where, yes, you need to ask and answer the question, is this a security or not? More likely than you could probably view it that way, but from a practical perspective and a legal perspective, safer ground to say, okay, this is a commercial arrangement. I'm not selling equity. I'm entering into basically a commercial transaction with a commercial party.
I can't imagine that this concert, no matter how successful, could possibly earn $500,000 with people buying tickets. So why would anybody want to invest in the first place unless you got some sponsors?
You got to
And that's
remember
not on
Steven
here.
Tyler's in the class.
But
do you think the
nobody
band
said
is?
Steve Tyler was going to be there. They don't know Steve Tyler's going to be there. So if everybody even paid $100 a ticket and you had 600 people in your high school class, I don't know what the math is on that. But I can't see how you make the 500,000. So why?
All right, so you're raising, this may or may not be a good investment, and you raise a good disclosure issue, right? Because if we're pre-selling tickets and that's a security, and maybe we can sneak it in under one of the exemptions, what about the disclosure that, by the way, if we sell all the tickets, we still may not get to $500,000. We still may not have enough to put on the event.
Right.
What about all those risky things that
That the event
we'd
gets
rather
canceled
not
and you
we'd
can't
rather
keep
not
on
tell the
money.
people we're.
Exactly. So, and this is what every business on Kickstarter faces, isn't it? Because this line of thinking, we're basically pre-selling a benefit. It's not really a security. We're not saying you're going to have an interest in our company in this line of thought, but we're going to give you an advance ticket, maybe if it's even on favorable terms. But on Kickstarter, the way you protect people who are looking to help an endeavor, not for a security or investment interest in the company, but for something tangible, you have thresholds, minimum thresholds, right? So you say, I'm not going to break escrow or take any of this money unless and until I reach enough of a critical mass so that I can deliver on my promise. And so that would need to be plainly disclosed, and that would be part of the basically a fiduciary duty of the issuer thinking about the people that they're collecting cash from and setting what that threshold would be. And that's actually something that we'll probably get to it, that theme comes up in other types of financings, not in this example where you're looking to raise interim funds. And you need to tell somebody, it's like, okay, I'm raising interim funds, these are the terms, it's even riskier than where I'm trying to get. Here's the premium that you would receive, here's the threshold that I'm going to close at, and you'll be able to think through, is that threshold reasonable? Because if it's not, if it's a failure on day one because it's just not enough money to get to where you want to go, then that's an issue.
Well, doesn't Kickstarter assume that money is all that you need? If you also have to sign up Steven Tyler, and you can't do that till you have the money. So you raise all your money, you get lots of Kickstarter donations, and now you approach Steve Tyler and he says no.
Right.
You have to disclose that.
Oh, absolutely, absolutely, because that is fundamental to the actual investment decision or funding decision that Steve Tyler would actually be lined up on to perform if, in fact, you reach the dollar threshold.
I didn't actually say that. I only said that we went to high school. We went to high school.
The other thing is you say this is an LLC, so let's assume these are 5 guys who come together in a high school class. There's the issue of, is there some liability related to the funding, but also the event itself? Somebody falls and hits their head and sues you. What's your liability as this 5-guy group?
Yeah, I would hope in insurance.
That's right, and also an LLC is an entity, so you'd be entitled to the protection of a corporate shield as long as you observe and respect certain corporate formalities. You don't hold yourself out as just high school rock or individually on behalf of the company. You do everything through the LLC itself. It will offer some liability protection. But also the nature, in this case, if we were talking about raising money by selling membership interest in an LLC, which I don't think would be very likely for something like this, right? But if you did, LLCs have different tax characteristics than corporations, and that would be part of the disclosure that you'd be making to potential investors, because investors in pass-through entities have, on one side, the potential benefit of pass-through of losses at the early stage of the investment, but on the flip side, there's a potential for an allocation of income and a need for a distribution from the company in order to meet your corresponding tax liabilities. So there are issues when you're selling interests in pass-through entities that need to be fully disclosed and thought through before you can actually take the money safely.
Okay, we'll try another example. Here we go. One of these basement chemist inventors came up with a compound that could evolve into a vaccine that would cure just about everything. Everything. The super wonderful drug. Great, needs $250,000 to see what happens to the mice. What's the ideal source of funding, and what sort of considerations should this particular entrepreneur think about?
SBIR. I'd go for an SBIR grant.
Your NIH grant, SBR grant.
Okay, so if you do grant, you give up no equity. If you give up no equity, it seems to me you don't have any securities issues. So it's a contractual arrangement. They give you the money, you do the work, they don't own any of your company. What happens?
They don't own any of your IP either.
Or your IP, and so what happens when you inevitably need to do your next round? Having taken grant money, you're still the sole shareholder. So no considerations in your next round. Your next round would be your first round.
Right. So actually, there's two issues there. That's right. So any type of non-dilutive financing obviously is very good for the founders. The securities and the securities laws issues are not as heightened because you're not issuing securities, right? But to come back to our very first example, your house needs to be in order before you bring in the grant money, because that will raise the valuation of your company. So every company at the outset has a window of time to issue equity to founders for very low consideration, because at that point everything is speculative. You have nothing much more than a business plan. So once you in the calendar bring money in or get close to bringing money in, it's more difficult and more complicated to actually issue securities. Now that's not necessarily just a securities law compliance issue, but it's just more of a overall, when you're issuing securities, making it work from a business perspective. So that would need to be in order before, hopefully, you even go too far down the road and bringing the grant money. After you bring the grant money in, and you're going out and further issuing securities based on hopefully getting past the beta testing and some favorable results, then the disclosure requirements are as to the terms of the financing, the potential. If there were any hooks on the IP in terms of scope of use or licenses or anything like that, you would need to disclose that. If there are ongoing reporting requirements that are conditioned to the grants, you would want to disclose those. This becomes an outstanding and very important contractual relationship of the company that then is going out to raise further funds requiring appropriate disclosure.
All right, so how about if I sort of follow the trend and all the regs are in place, and I said, this is the perfect Jobs Act crowdfunding, everybody's going to love this, I'm going to cure everything, right? So I go find some crowdfunding website, and I get 75 investors, I raise $250,000, and I do the mouse thing, and it looks promising, and I come to you and say, I'm ready to do another round. Now I need to raise $3 million, and here's my company. By the way, I raised $250,000, and I have 75 investors.
So not ideal, right? Because your cap table then is complicated. And actually, this is an issue that's addressed by many of these SEC portals where they actually will bundle in the crowdfunding investors into one entity to make some of the ongoing voting and communications issues a little bit easier. But to take a step back, with any life science company, you know that $250,000, $1 million is not going to be enough, anywhere near enough to get through the regulatory hurdles in order to actually bring a product to market. And so you're going to be looking for investors or strategic investors or licensing arrangements in order to get to some next threshold in terms of being able to raise money to continue on or hand it off to the entity that has the capability to continue to develop the compound. But to take it back, in this case, if here you are, you've raised $250,000 in a crowdsourced fashion, there are integration rules, right? So if you've done that within a year of your next financing, you have to step back and take a look and say, okay, well, how do these two offerings fit, and does this second financing blow the first? Secondly, it's like, okay, well, if I did crowdfunding and if that involved general solicitation, does that in itself blow my ability under 506 to go ahead and raise money from an additional investor because I've done something for one set of investors that wouldn't be permitted for the next? So that's where it gets more complicated and something that you need to think through, not when you say, okay, I'll deal with it when I get there. You have to deal with it in advance because your first investors need to know if there is a risk that the nature of their investment itself, the way in that you're conducting the offering, could impact your ability to raise money in the future. You want them to know that so that they don't come back later and say, had I known that, I never would have given you my money.
So I want to ask you a question, and maybe it's a comment, about integration. And see if we can't translate that into English.
Sorry, yes.
Right, and it's not a problem. So it's Rule 503,
Right.
raise $1 million, up to, right? But I really need
504.
504, but I really need $3 million, right? But I don't want to go through the, all of those. So it's an easy rule, 504, right? $1 million, register with the state, off I go. So I know what I'll do. I'll raise $1 million, right? I'll close that, and then I'll just keep on the road and raise another $1 million, and close that, and raise another $1 million. And in 90 days, I'll have my $3 million, then off I go. Can I do that?
Right, as you can imagine, no. So the rules do contemplate that that creative idea would have been thought about, but no. Anything that you do within essentially a 12-month period gets looked at on a combined basis, and then you look and see if you still fall within one of these set Reg D exemptions. And another note is that when you do an offering that relies on one of these exemptions, you also file a Form D with the SEC, and I should have mentioned that before. And so this gets sent off within a certain period of time of the closing of the round, and you basically tell the SEC that you raised a certain amount, and you name the directors and the officers and everything else. And that's one of the conditions to be able to rely on the exemption, subject to certain limitations. But so the SEC will know if you are actually trying to take advantage of the exemption and you file 3 Form Ds in a row, all saying 504, and they add up to more than $1 million, on its face, it's not going to comply.
So there's an organization I became aware of that presents himself as an LLC, and they present themselves as going out, doing some crowdfunding, raising a pool of money, and they would, the LLC would actually be the investor in your company, not the population that put the money up on the table.
And that's actually the direction that we're seeing a lot of these crowdfunding endeavors go, because it doesn't make sense. So, in Neil's example, having 7 investors, not great, but manageable. But if you're raising, $1 million or $500,000 from people who can actually, under the Jobs Act, invest $2,000 at a time if they make less than $100,000 a year, that very quickly could become an unmanageable number of shareholders to deal with. So in order for these crowdfunding portals to convince issuers that this is actually a viable and attractive way to go, they say, well, we've thought about that. we will bundle in all these crowdsourcing investors into one common LLC, and on your books and records, you have one shareholder that has a whole bunch of underlying members.
Could you also address, because I've done this, I had this problem with cap tables, the, what's the word? The length of time the investment group wants to be in your company, and you have this hodgepodge of people, and not people, but investors who want out in 3 to 5 years, others in 7, and then you can't give them their money back. You have to do. So I've seen different approaches there. So this hodgepodge of investors creates problems, not just in the front, but the back end. So talk about the back end.
Yeah, every time you take money from anyone in exchange for a promise, you're getting married, right? You're getting married, and they're going to be in your life one way or another. If everything goes well, to a lesser extent, but things can go well or things can go badly. If things go badly or well,
Or just take longer.
and take longer, things are different. One, if you have a fund that has, at the time they invest in you, a 4-year remaining life, when you get to, say, 3.5 years, you're going to start seeing some pressure from your investor and perhaps the board representative that says, well, where are we going? You may want to go another 2 or 3 years, things are going well, and build more value. They would just as soon sell your company now, report back to their investors, the limited partners, how well they did. They don't actually want to give the money back to the limiteds. They distribute it to the limiteds and hope to get it back in their next fund. You're not in their next fund. Your interests are no longer aligned in terms of how you get out. That might be 1 or 2 investors, and it's a consideration when they come in and look at your business plan. When an investor comes in, how long are they investing? What are their expectations? And how easy would it be for them to extend that is something that you should know up front. You might also find that you've got differences of opinion if you have an investor group where some have 3 years to go, some have 5, some have 7, some don't care, and some will look at the opportunity of another year or two's value versus the difficulty of having to go to a limited and say, well, we were only kidding when we said 5 to 7 years. So yeah, I think the big point is know your investor and know what you might need to ask later. They're not passive shareholders. In some ways, they're all active shareholders. It's invariably you will be calling them, you will asking them to sign something for some consent because you need to do something that by virtue of some contractual document, whether it be your charter, an investment agreement, or otherwise, you can't do without their consent. And so if you've done a Crowdfunding Jobs Act and you have one LLC to deal with and one point of contact, you send them the form, they send it back. They don't send it back, you call them up. Think of having 75 individuals who have moved on. 3 of them have died. You can't find their estate, you can't find their grandchildren, and your investor says, I love your company and all I need is 100% consent from your current investors. Those deals don't always get done, and they get done with difficulty. I like to say buyer's remorse enters into every transaction. Anything you're investing in, anything you're buying, you always have remorse. If you want to close, you have to close before buyer's remorse sets in. Sure.
You made a reference earlier to the person that says, I know somebody that would invest in your company and you bring them together, but I want a piece of the action for doing this, and if they're not accredited, it's illegal. I was told by a lawyer that this happens a lot, and the way that person gets paid is as a consultant. Can you comment on that?
So the issue would not necessarily be whether or not the investor is accredited, but in that example is if somebody's compensated to help an issuer raise money, and they actually have a financial incentive tied to dollars raised, they need to be registered as a broker-dealer with the SEC.
I meant as a broker-dealer.
Yeah.
Okay.
And so, you're right. So as a practical matter, it happens more often, I think, than lawyers would like to know. And it's sort of one of those questions, and I get it all the time. People will come to me and say, well, so-and-so is in this business. They help people raise money, and can I do it? And my counsel is always, okay, well, here's the rule, and here's reality. The rule is that unless you're a registered broker-dealer, you're not supposed to be raising money. There are certain consequences, frankly, for the person who's actually holding themselves out as able to do that. The consequence to the company is the potential that the offering itself doesn't comply with applicable securities laws, and that can come back to haunt you in two ways. One is, hypothetically, that the investor who's interested in your company comes back later and for a change of heart says, I want my money back. And the second is that in the course of due diligence for a later and even more important transaction at the time, somebody raises their hand and says, wait a minute, that looks like that was not in compliance with applicable securities laws. How would I buy those securities if they haven't been issued in compliance with applicable law? I need a legal opinion, I need something to make me comfortable. So that sets the framework. The reality is oftentimes consulting arrangements will be entered into which don't tie directly to dollars raised, because certainly consultants can help you put a business plan together. They can help you expand your network, right? They can do a lot of things up to a very gray line, but at some point it looks and smells like a commission. And when it does, that's when you have to take a step back and say, I'm not going to talk myself into this, or if I do, I need to know that I'm taking a very serious risk with respect to securities law compliance. But absolutely, I mean, it happens quite often where consultants will say, it's not a fee, it's consulting services, happens to be tied to the company's ability to pay, and the company's ability to pay happens to correspond to the raising of money.
I think I might fit right exactly where this lady asked your question. So a while back, I was in severe financial trouble, and Neil offered to help me get out of that at one point. We had some big conversation. But I also had a friend in the same business that I used instead. Sorry about that, sir. So he got me in touch with different bankers and whatever, and I ended up with securing an SBA loan and got out of the financial issue I was in. However, I had to pay a percentage commission to this person. Does that mean that person had to be a broker-dealer? Or should have been a broker?
It sounds like it. If this person entered into agreement, yeah.
So, the one that's clearly not allowed, right, is I'll call 3 people that I know really well, right, and however much they invest, pay me 10% of that, right? If I'm not they pay.
Rather than I pay.
No, the company would pay me. I'll raise $100,000. You keep 90%. Pay me 10% as a commission, because I brought in Rob Adelson and he invested in the company, and you never would have known him but for me. I can't do that if I'm not licensed. On the other hand, if I say, look, sure, I know a lot of people, and I'm happy to introduce you, but I can't be directly compensated for that. So I'll help introduce you, but I'll also review your business plan. And who knows where contacts come from. I talk to Rob, Rob says I saw something interesting. Next thing you know, Rich McCann is investing in your company because he heard the buzz on the street. And so I say, look, I'll help you, but however much you raise from anywhere, I want 5% of that to pay me for my time and effort in helping you. So now, the company raises money from someone I don't know and didn't introduce you. That, I think, is okay.
What's the difference?
Well, the difference in that example is that when you're not bringing targeted investors to the table and you're not specifically telling that person, oh, you should invest in this company that I know, great things are happening, and have more direct contact in terms of the selling effort, that becomes more problematic. But even in the case where you are just anecdotally or incidentally receiving a fee based on dollars raised, that is a red flag that needs to be addressed. I mean, anytime you actually tie a percentage to dollars raised, it's a potential issue.
I just want to comment on Neil's suggestion. I think the difference is, the way Neil was positing it, you're getting whatever it is, 5% or 10%, whether or not anything is raised, which is almost like you're getting stock in this company. And from the issuer, from the entrepreneur's viewpoint, it's sort of a dangerous thing, because if this guy does, if the company doesn't raise anything, they've got a commitment to this guy, this person, for 5%, versus a situation that says, if you raise $1 million, if you raise whatever it is, you'll get 5% of that. So it's tied to his success. What Neil was positing was not necessarily tied to success. And if it's not necessarily tied to success, perhaps you would agree, Edward, that might be kosher, if it's not tied to success.
If it's not tied to success, if it's just a percentage, but then it becomes an issue, because when you're then going to raise the money from a stranger, you're going to say, oh, by the way, even though this person had nothing to do with raising money, they're going to get a fee. They're going to get 5% of your.
So what Rob's advice to me is, the less I do, the less trouble I get into.
I think the situation when I was talking to Neil, was more in a dollars per hour kind of consulting direction, rather than.
Right, so this one I'm pretty sure is okay.
Yeah.
Right?
Yeah.
So we have a lot of people, and a lot of people in this room, they need capital to launch, right? And so their ability to pay is extremely limited, right? And so if I were to enter into an arrangement that says, I either get a retainer or I get paid by the hour, and I'll risk adjust it because I know you're poor, but at some point in your future, I'm going to have built up this bill. You owe me $3,000, right? And you'll pay me when you can afford to pay me. And I'll define that as, if you raise money, some percentage of that can be earmarked to me, just like some percentage of that can be earmarked for rent, right? If you're profitable, where you have revenues, some percentage of that can be earmarked for me. That just says I now have a pool of cash, but I'm not tied to, I've introduced you to Rob Adelson, Rob wrote a check, and but for my introduction, that's a commission for actually selling securities to Rob, which is really where the hard line is.
As we talk about this, my memory gets better. I'm pretty sure that I went the direction I went because I didn't have money. I didn't want to be holding to somebody, full on a fee in the event that I collapsed. So that's why I went. It was the percentage was tied to performance.
That makes sense. So.
I guess the real reason I'm asking this question, I'm not asking if this guy should have been a dealer broker to get my money back. I'm just asking if I put myself in a tenuous situation in the future.
So the quick answer is that if there is a question about whether or not that payment of a fee constituted a payment of commission to an unlicensed person, the potential consequence is more likely than not going to be that your investor or the SBA is going to call it a loan. It's going to be when your next investor comes in or an acquirer comes in, they'll take a look and say, does that commission cause an issue for me personally based on the securities that I'm buying from you, or a liability that I'd be inheriting from you based on this particular offering? And to Neil's point, alternative fee arrangements are fine. If your compensation is based on services rendered and the actual payment is tied to funds in the door, that's fine. Commissions based on success of raising money, that's an issue.
Okay, 3 players, company owner, myself as commissioned salesperson for a product, but also the owner had told me, oh yes, you raise some funds, you'll get 5 of them, whatever. And then the investors who eventually did come along. I will claim ignorance, which it was. I was not familiar with these, I was not a registered agent, a deal broker. So I was quite astonished that, and I guess it was, well, was the owner should have known that they were in no position to offer, they were offering me something that was illegal.
Well, it happened.
Versus the investor who knew he was getting diluted. So, hey, I'm not cutting off. I'm putting $100 in here, not $95.
Right. So happens all the time, right? Because founders and entrepreneurs are looking to raise money, and they're not thinking of potential ways that they shouldn't be, right? So, and as a matter of fairness, it takes a big step back. No, as long as nobody's not doing anything, somebody's not going out there and raising money from people who can afford to make these investments or unknown cast of characters, right? So this always becomes a little bit of a surprise later, and it's not that uncommon to say, oh, wait a minute, did I do something wrong? Technically, was that a football? And it happens a lot. But so to your point, who should have thought about the issue? It really should have been the founder, or if your agreement was reduced to writing in any way, the lawyer who would have been helping you would have said, oh, wait a minute, I can't actually do what you're asking me to do without walking you through the potential consequences. Now, if it's just an oral promise to you that says, oh, by the way, I'm going to give you a certain percentage if you help me, if your friends and family bring money in the door,
Good luck.
yeah, exactly.
Can we talk about this from the investor's perspective? Do investors want 10% of their money going to not developing the product, but paying someone to raise money?
Normally not. No, investors don't. They want all of their dollars to be going into the company. And that's why it's such a disclosure issue. And they also want to know that if they're working through an intermediary, and that intermediary has a financial interest, and you're making an investment, well, there could be a conflict there, right? So that might color the way that they view the disclosure materials. So by and large, having said that, that's along the spectrum of raising money. If you're engaging with a placement agent and everybody knows that the way this company is being brought to market is through an intermediary that's packaging the company and vetting it and doing due diligence and has a track record of bringing good companies to well-heeled investors, well, then they might say, well, 5-7% placement agent fee is customary and appropriate. But by and large, for the more typical early stage friends and family seed rounds, no, they don't want to see money going to being paid commissions.
Yeah, my experience, and mostly in later rounds because the dollar sizes go up. If you have a placement agent, it's not that the investor is opposed to the placement agent receiving a fee. It's just not going to be paid, everything else being equal, by the investor. So if if a company's value is X and their investment is whatever it is, they would expect to get some, do the math, percentage of the deal, not 10% less than that. So they see deal flow from agents that they trust, that's fine, but it will, make no mistake, that fee's not going to be paid by the investor.
My self-serving question here. Now that you've painted the picture of how expensive and how complicated and potential liabilities of equity funding, you need $250,000 for your machine to make your widgets or to pay a manufacturer to make them for you. Other ways other than equity to get that $250,000 that doesn't have all these complicating factors?
Yeah, so one great way to raise capital is to raise it from a potential customer. Get a purchase order with a deposit. That's really fun, right? No dilution, no equity, no future, and as long as you can actually deliver the product that they order, then everybody smiles at the end of that day.
And another variation of that theme is if you get to the point where you can do some exclusive license arrangement and get an advance on the license fee, it's another way, non-dilutive financing, to to get the company some funds without actually selling equity.
Ed, is there some presumption, if you have, for example, consultants, advisors, vendors, you say, I know you're a startup. Everybody did this. Google did it. Said we need you to paint the office. Can you paint the office? We'll give you like 5 shares of stock because we just started up. And the painter said, like, I hear this story all the time. No, thank you. But so if you're an independent contractor of sort of legitimate independent contractor, can you take equity as a, you're not accredited and you just say, thank you very much. Here's 5 shares of stock and everybody's happy. Is that okay? Or you get in trouble later?
You can. So, about to get the hook here, but the you can use, so your stock book is not a checkbook, right? You can't just be issuing shares and saying this is worth $10,000, here you go, because you are issuing securities every time you do so. Also, there are tax consequences for the recipient. Taking non-cash consideration for services rendered means you're going to have income without the corresponding cash to pay the tax on that income. But in the case of Google with the mural painter, when you're using stock options for consultants, there are exemptions that are available, and generally, as long as you comply again with certain disclosure requirements, or if it's under a stock option plan, there are other exemptions available. It is an appropriate way to use stock.
And you could do all of this at home without calling your lawyer.
I wouldn't recommend that. So,
can you guys stay a little bit after the presentation? Okay, so it's now 9:30. We have the room for a while longer. Let's give a hand to the great presentation.